Today we'll be talking about the conceptual framework. There are three levels to the conceptual framework. The first level is the basic objective. The second level is the qualitative characteristics of accounting information and definitions and recognition criteria for financial statement elements. The third level is the underlying assumptions and measurement concepts. The first level includes being objective and decision useful. To be objective, you must provide information about the reporting entity that is decision useful to present and potential capital providers. To provide general purpose financial reporting, you must recognize a broad range of users. Financial reporting refers to financial statements and the footnotes accompanying the statements. To be decision useful, there are two elements, like and stewardship. Like refers to how useful it is to predict future cash flows of the reporting entity, while stewardship refers to how management has been doing. When we talk about primary users, we know that the rules are constructed with the primary users in mind. Some of these users can include owners, creditors, and payables. The second level includes qualitative characteristics, relevance, and elements. Qualitative characteristics are fundamental and unchanging. They are the framework. Relevant information is capable of making a difference to a decision. They can be predictive or confirmatory, which is also part of the stewardship function. Materiality is an important concept under relevance. If the information is large or special enough to make a difference in a decision, then it is considered material. If the item is not material, the managers can bend rules that would otherwise apply. Next we have elements, which we would look further in depth in the next lecture. The elements include assets, liabilities, equity, income, and expenses. The third level includes assumptions that are explicit and implicit, as well as measurement methods. The explicit assumption is going concern, meaning the entity will continue into the foreseeable future. The implicit assumption of periodicity refers to an entity's life being split up into equal sections. There are several measurement methods, some of which include cost, fair value, and present value. Some of you may know about the reporting entity. There is currently an exposure draft on it. When it is final, it will be part of the conceptual framework as definition of the reporting entity. The reporting entity is not just a legal entity, it can also be a legal fiction, such as group accounts and businesses and its subsidiaries. It exists to separate the entity from its owners, which is known as a separate entity assumption. This is done so financial statements would be reported from the entity's perspective.